Hello and welcome to a brand new episode of Smart Money. Today on the show, we talk about what the various factors are that you need to consider before getting either a health or a term insurance plan, the do's and don'ts of insurance, and if you have any ailments like, say, diabetes, what are the insurance plans available for you? Joining me on the show today is Dheeraj Shegal, who's the Chief Distribution Officer at Bajaj Allianz Life. Dheeraj, thanks a lot for joining in.
Thank you so much.
You know, insurance is a bit of a tricky subject, right? A lot of people still don't understand it. So let's start with the basics. Let's try and differentiate between term life and whole life, term life insurance and whole life insurance, and who needs term insurance, who needs life insurance. If you can just, lay the groundwork for us.
Sure. First of all, Sonia, thank you so much for having me on the show and to pick up this ever so important topic of life insurance. I think COVID has made the need and the discussion more pronounced than it ever was in past. As far as life insurance is concerned, two cardinal fears that we all have in our mind is that what if I die too young? What is going to happen to my family and the financial liabilities and the responsibilities that I have towards my family as an earning member or as the breadwinner? And the second one is, what if I live too long? Am I going to survive on the savings that I have for myself and my family, and am I going to sustain the lifestyle that I have?
So either way, it's a problem, right? If
yeah, either way, it's a problem.
If you live too long.
Absolutely. And life insurance is one product which perfectly takes care of these two fears or concerns that we have. Coming to your question which you asked, what is the difference between a term insurance and a whole life insurance? Term insurance is plain and simple life insurance. Somebody buys a life insurance plan considering the future liabilities or the responsibilities that the person earning member has towards his or her family. What is the amount of cover which is needed? At what age is the person buying? Person buys the term insurance plan. God forbid, if the bread earner dies, family gets the lump sum amount so that they can take care of their future responsibilities. That's the term insurance plan.
In fact, we have a very helpful table here, the term insurance and whole life insurance, right? If you want to go through these one by one.
Absolutely. So temporary versus permanent means that if I am buying at a certain age, let's say somebody buys at the age of 30 and feels that the responsibility or the financial responsibility would cease to exist at the age of 65, then the person buys a term of about 30-35 years. Okay. Yeah, because at that time there is no financial responsibility to be met. Whereas whole life, if you see it is written as permanent, it covers the person till the age of 99, which means even after the premium paying term gets over, if something happened to the person who's buying the policy, the family would still get the benefits, the financial benefits which he or she had signed up for. So that's what the first 2 points, right? There's no cash value which gets accumulated in term plan. The family gets the money only when the death happens, the death of the family, the member who's bought the policy happens. Whereas in whole life, there is also an element of cash. You can accrue cash value over a period of time which gets paid to the family. So
when does it get paid to the family?
When the policy starts getting matured or the benefits start unfolding, you start getting those benefits.
But this policy, whole life policy, is like till
the age of 99. Yeah, so the family can get the benefit of both these plans. If I had to recommend, I would say that people can look at a combination of the two, term insurance as well as the whole life plan. In case of unforeseen death, the family gets the lump sum amount which comes from the term life side, and family can also continue to get the cash benefits which get accrued in the whole life plan over a period of time. So if there's somebody who's got a home loan, one amount of cover in a limited amount of premium that you pay. As the age increases, the premium goes up and term insurance becomes slightly more expensive to buy. Second thing is, in the earlier stages of our lives, we don't have too many health conditions, and hence it is advisable to buy term insurance early on.
Earlier, okay. Let's go through that. Pure death benefit payout and death benefit payout guaranteed. What's the difference?
So pure death benefit payout is that whatever is the death benefit that you've taken, let's say somebody buys a policy which has a death benefit of 50 lakh rupees. The family, in case of the death happening in pure term life plan, family gets that 50 lakh rupees and the relationship with the insurance company gets over there. In the whole life plan, there is an element of death benefit as well as the guaranteed payout which is associated with the whole life plan. So the death benefit will come and you will also continue to get the benefits during the term of the policy.
And the final one, you want to go through it?
Can renew or convert, it simply means that, if I have taken a policy which covers me for a shorter period of, let's say, 15 or 20 years, I can either buy a new policy or I can convert that into a whole life plan. Whereas whole life plan covers you for 99 years, that really can't be converted.
Okay, all right. So these are the basic life insurance, the term and the whole life insurance, right? This is very helpful actually. A lot of things that even I sort of needed to revisit. Let's talk about ULIPs, right? Because that is one slightly debatable investment because it mixes investment and insurance.
Yes.
So as someone, a lot of people believe that you should keep investment and insurance separate. But I want to understand both the pros and cons of investing in ULIPs.
See, ULIP, as the name suggests, if I expand that, it says unit-linked insurance plan. For a layman, it is an insurance where the part of money which is going towards your mortality risk, which is associated with the policy features, and large part of amount which you are giving is invested in markets, in the stock markets. The pros of buying this are, so for let's take two kind of customers. One is who's an evolved market investor. Let's say if you are an evolved market investor because you understand markets, for you the benefit of buying a ULIP is that you are able to switch your investments from time to time from one category of funds to another category of funds without any charges of switching. There is no tax implication, there is no entry load or exit load, and you can, as per your preference, as per your reading of market, you can switch your funds. However, if you happen to be somebody who does not understand the market so well, because of the long-term nature of life insurance savings, you can leave that money in the hands of experts and still enjoy the benefits of the returns which the stock markets are giving without taking any added risk of making your own assessment and judgment on what kind of securities to buy. Okay. Life insurance cover comes at an added benefit on that. So those are the pros. I don't really want to call the other part as cons, but some of the things that you need to be watchful about. First thing is, please understand that it is a market-linked plan. And stock markets are subject to volatility. So there would be times when your investments would not be giving you returns as per your expectations. But it's a long drawn plan. If you are holding your money in stock markets for a longer period of time, you are paying your premium regularly, you are getting the advantage of rupee cost averaging. Eventually the plans would give you returns which are as per your expectations or doing as good as markets, if not better. So that's first thing, volatility of market you have to be comfortable with. Second thing is, which is true for all the life insurance plans actually, but more so for ULIPs, that the money that you're paying in ULIP plans is locked in for 5 years.
Yes. And that is my big issue with ULIPs. You know, why would I lock in my money for 5 years in equities when I have an option right there to invest in mutual funds, which is so liquid, I'll get my money the next day. So why should I make that lock-in?
Sonia, if you look at any of the market-linked instruments, longer you hold on to the investment, better are your chances of making better returns.
That point is taken. Yeah? That point is taken. But just the fact, knowing that my money is not available to me for 5 years, I'd rather just put it in plain mutual funds, right?
Look at it the other way. Use this as an opportunity to have a very disciplined long-term savings where even if you have that temptation to withdraw your money and put it in something else or put it in another financial goal or aspiration that you have, this is something which is used for planned long-term savings to meet your life goals. So look at it as an advantage that you will have to hold that money at least for 5 years. It increases your chances of getting better returns because you know that over a period of 5 years, markets would definitely give you better returns, and it gives you the opportunity of having very, very disciplined corpus built for you.
Okay, well, there are several points that, to ponder over on ULIPs, right? Personally, I believe it's better to keep your investments and insurance separate, but there is a product for everyone in the market, I guess. Let me do one thing. Let me take a short commercial break. Many more questions lined up for you. Don't go anywhere. We'll come back and demystify everything to do with insurance in just a bit. Welcome back to Smart Money. We're talking about the do's and don'ts while investing, or rather while buying life insurance. We have Dheeraj Shegal, the Chief Distribution Officer at Bajaj Allianz Life with us. Before the break, we were talking about ULIPs and the pros and cons of, investing in ULIPs. But I also want to talk about PAR plans, participating plans, right? How does it benefit a policyholder?
As the name suggests, participating plans are the non-linked traditional plans. Participating means that you get the guaranteed benefits which are already mentioned in the policy features. You also get to participate in the profits of the organization in form of bonuses and dividends which get announced from time to time. Typically, insurance companies announce these bonuses at an annual rate. So annually, the bonuses get announced, and that's what is called participant plan.
Okay. The big question I always ask myself is, how do I determine how much life insurance coverage I would need at different, age points?
So it depends on various factors, Sonia. First is, at what age are you buying? What are your financial responsibilities and liabilities that you want to cover? What is your lifestyle? That is a big determinant on what kind of cover do you need. What are the what are the health conditions that you presently have? So these are some of the factors which really help you determine what is the kind of cover that you need. There are rules of thumbs which every financial planner will have. Typically, they say about 20 times the multiple of your annual income is sufficient. But I would recommend that look at your financial goals and financial responsibilities that you have, the kind of lifestyle that you have, and assume that if you're buying a plain life insurance product and tomorrow if you're not there, would your family be able to meet their financial goals and sustain their lifestyle with the amount of cover that you're taking? And always remember that earlier the better. And as your financial goals and responsibilities go up, keep enhancing your cover.
Okay. I'll come back to that in a bit. But before that, a lot of young people now deal with lifestyle diseases, right? So whether it's pre-diabetes or even diabetics, right? The age has become younger. There's heart disease as well that people are battling with. Earlier, it used to be common at about this age group of 40 to 50. Now it's become 30 to 40. In such a situation, how can I ensure that being young, I get the right insurance coverage having such lifestyle diseases?
So again, first, overemphasizing, buy it young. At the age when you do not have the health conditions or the lifestyle disorders, it's better to buy life cover early. Second thing is, there are products which today have features which help you buy life insurance even when you are carrying some pre-existing disorders like diabetes. We created our industry's first diabetic term plan about 6 months back, where if there is a person who is diabetic and has HbA1c, that's the uniform barometer used for checking how well you are managing your condition. If your HbA1c level is less than 8, even if you're a diabetic, you can buy this term plan and secure your future life goals. Important thing is, declare your health condition at the time of buying, so that in case of a claim stage appearing, there is no disappointment for the family because of concealing the health conditions.
Okay. And any other products, any other such products that you would have? I'm just trying to understand, apart from diabetes as well, there are so many other preconditions that people deal with at this age, right? How does one structure it? Do you factor it into your current policy? Do you take a separate policy for that? How does it work?
See, conditions like diabetes, you can factor into the current policy itself. For covering your other conditions which may or which possibly can impact all of us, there are riders, there are health riders, there are critical illness riders which you can buy, there are riders around cancer which you can add to your policies. They enhance your cover. They enhance your cover so that you are able to meet your financial liabilities in case of any of these health conditions derail your financial goals.
Okay. What are the red flags? I want to understand that. There are a lot of loopholes. I do know that while buying insurance, there's a lot of mis-selling that happens of products as well. From someone like you who's been in the industry for so long, you want to just, educate our viewers on what are the red flags or loopholes that you need to be aware of before buying insurance.
Try to understand what you're getting into. It's as simple as that. What do I mean by that? Whoever is proposing that solution to you, whether it is your bank staff member or it is your advisor, or you're trying to buy it on your own, because there are a lot of people who buy insurance on their own these days, try to understand the terms and conditions, try to be very, very clear about what financial goals you're buying it for. Please remember that these are systematic, long-term investments. During COVID, we saw a lot of such people who had bought their insurance plan but did not pay the renewal premium, and unfortunately, the claims could not be honored. There are people who buy insurance plan and they lapse the policies, they end up losing the money, and their families end up losing hope because they don't get the claims. If you don't understand anything, just get your doubts clarified. Make sure that you are filling up the form on your own. Your signatures are matching if you're filling up the physical forms. The KYC documents that you're giving are authentic, reliable, and you've gone through all these things. These are some of the basic red flags that you have in all the products. I just re-emphasize only on one point, that these are long-term investments. If you're buying a regular premium paying plan, ULIPs, I told you, are locked in for 5 years. Likewise, the traditional savings policies like participating plans that we spoke about, if you have bought it where you are supposed to pay your premium for 10 years, make sure that you don't deprioritize that premium payment, because it is to cater to your own financial goals in the days to come. And term plan is for your family's safety, so pay premium regularly.
Okay, all right. We'll leave it at that. Thanks a lot for joining us and, taking us through this entire process. Picking life insurance, I believe, is one of the cornerstones of, building your wealth and creating your portfolio through the course of your life. So thank you for educating our viewers. Any final thoughts before we...
Thank you so much, Sonia. And once again, thank you so much for having me on the show. And I would again urge everyone, please buy your life insurance carefully and make sure that you use them for meeting your financial goals.
All right. Thanks a lot for joining in. And to all of you viewers, thanks for tuning in. Have a great weekend. And if you have any feedback, you can write into us, you can mail us, and, write into us on our social media platforms as well. We'll be sure to take up all of your queries. Until we meet again, have a great weekend.